I think the political calculus at the moment is that the Labor Party thinks high immigration is good for it in the long term because it thinks new immigrants tend on average to vote more for the Labor Party than the Liberals. That's perhaps less true than it used to be, but I think that was the calculus for the Labor Party initially. And the Liberal Party, unfortunately, I think, is increasingly in its representative part of the Liberal Party, not the rank and file, but the representatives of the Liberal Party, parliamentary representatives, are increasingly focused on what they think the interests of big business are, not the interests of average Australians or in particular small business.
Good afternoon. Welcome to Season 3 of the Macquarie University Liberal Club Sunday Sessions podcast, live from the Facebook main page. My name is Andrew Cummin, and I'm joined with Rory O'Connor.
Hey, how's it going, legend? Good to be here again.
That's good to see you again. Good to see you. So today we will be talking about housing prices, and they have been skyrocketing. Perhaps you've noticed. Joining us today is Andrew Stone, Chief Economist for Tony Abbott during his Prime Ministership, and an economist of over 25 years. He's also the author of the book Restoring Hope, Policies to Revitalise the Australian Economy. Andrew Stone, welcome.
Thanks very much, Andrew and Rory. It's a pleasure to be here.
It's good to have you here. So as always, you can pose your questions to Andrew, and we'll try and get to as many of them as possible throughout the hour. Our first question, so part of the Australian dream is the ability for a person to own a house. Why are Australian house prices continuing to increase in price?
Indeed, it's a very good question. And when one steps back from what's been happening in the past 2 years, one really realizes how bizarre it is that prices have been skyrocketing so much since the middle of 2019 and especially during this pandemic. It's such an odd thing to think we have a global pandemic, a situation where GDP is actually lower now, and the most recent GDP data put out by the Bureau of Statistics is actually lower than it was 2 years ago, directly before the pandemic started. And yet, over this period, house prices have gone up in Sydney, for example, by about a third, and that's on top of massive price rises that had occurred prior to that in the period since about 2012 already. So it's a very good question. How in this period of economic uncertainty and turmoil can prices be rising? The short answer at the moment is the reason they're continuing to rise is because of the, in my view, feckless and irresponsible behavior of the Reserve Bank. It's because money is so cheap at the moment is the reason that house prices are rising so much. If you take a longer perspective, house prices have actually been rising very rapidly compared both to incomes and wages and to other prices in the economy for about 35 or 40 years. But there have been a number of distinct periods. Since the mid-1980s through to the mid-2000s or so, there was a period where the shift to low inflation, stable inflation, and financial deregulation caused a big level shift in house prices. But that had more or less come to an end by the mid-2000s, and then we went through a period of 5, 6, 7 years where house prices were broadly stable compared to incomes. Then, unfortunately, however, from those mid-2000s, we had a situation where a factor we might come back to actually massively increased immigration, as well as other forms of foreign demand for housing, started to put a lot of pressure on housing prices, and they drove prices up rapidly, particularly from the period from about mid-2012 to mid-2017. There was then some correction, but unfortunately, rather than that correction being locked in by the Reserve Bank was already cutting interest rates to astronomically low levels, unprecedentedly low levels, lowest levels in 80 years, even before the pandemic hit. Then the pandemic hit and they slashed them essentially to zero, and we have quantitative easing. And essentially we're in a situation where house prices will go as high as the income constraint allows them, in the sense of you can only devote so much of your income to paying for a mortgage. But if you set interest rates extremely low, then the main upshot is that you allow people to bid up housing prices. And this is, I say, a feckless and irresponsible behavior by the Reserve Bank, because although they have to set interest rates, taking into account not just house prices, but how the overall economy is going, the performance of business investment and so forth. Nevertheless, they've actually managed to achieve none of the main goals for which you'd set interest rates so low, in particular trying to promote business investment. All they've actually managed to achieve by this policy primarily is to drive house prices even more out of the reach of young Australians.
Our next question is, there are concerns internationally over Chinese developers defaulting hard enough that it may cause a crash. Now, we actually have an audience question that's come in here, and it says, How is the Evergrande group impacting housing affordability in Australia? So for audience members, the China Evergrande group is the second largest property developer in China by sales,
and has about $300 billion US dollars worth of debt there, which is potentially at risk. My sense is it's very difficult to tell exactly how particularly the Evergrande crisis, or the fact that it has already spread to a number of other significant Chinese property developers, to what extent it is having a direct impact on the Australian market is difficult to gauge at this stage, because there are some direct connections in the sense that because there's been increasing investment in Australian apartments, particularly by foreign investors, sometimes actually investment in Australian property that's been flagrantly against the law, and we can talk about that more later, but there are some circumstances in which foreign investors are allowed to invest, and a lot of that investment has come from China. And to the extent that some of those people who put money over here are now facing significant turmoil in their own finances back in China, that may be generating some effects within the apartment segment of the market, more so than established single dwelling housing. But the bigger possibility here also is that an extraordinary proportion of Chinese growth for the last couple of decades, has been in the form of infrastructure, and particularly housing development. And in particular, that's helped the Australian economy enormously by driving up the price for iron ore and metallurgical coal, especially, because there's enormous production of steel and so forth to build these apartment complexes in China. If you get a major correction, if the Chinese authorities are not able to throw enough money, and it would have to be a truly gargantuan amount of money to try to ease the way through this crisis. If you've got a sort of hard correction and a significant slowdown in investment, that will have a big effect on our economy, not just through these links in the housing market itself, but through our terms of trade, the prices we get for our iron ore and our coal, and that in turn, affects both the amount of money out in the private sector in people's pockets, the flow-through effect from the mining sector, also severely affect the Commonwealth budget. And there's the potential then to have a really major negative effect on Australia, which would then in turn flow heavily through to the housing market as well. So it's very early days to say what's going to happen, and the Chinese government they're anxiously trying to knock heads together and get creditors to make agreements and arrangements and defer requirements for repayments from groups like Evergrande. But sometimes when you let things get so big, as the Japanese discovered in the late 1980s and early 1990s, when you get property market imbalances become too large, sometimes it's just not possible to sort of manipulate things enough to try to engineer a soft landing. It remains to be seen whether China can manage that, but there's a lot of pressure there.
We do have an audience question along those lines. Some economists say we're in the midst of a housing bubble, but their predictions about when it will burst always end up inaccurate. Why is this? Will the housing bubble ever burst?
Well, it's a very good question, and I am one of the people who, I preface my comments by saying it's easy, I think, to say we are in a sense in a bubble, but the really hard thing is to say when it's going to burst. And the reason it's become much harder to gauge that than it ever used to be, again, because of the behaviour of our central bank. If you go back to the 1980s and the 1990s, even in the 2000s, you had a situation where if housing prices started to get absurdly out of kilter with other, in their growth with other prices in the economy, and there was major relative increases in housing prices, that became a significant factor for the Reserve Bank. So, for example, in the late 1980s, actually, the Reserve Bank overreacted to housing prices, and they drove interest rates up. It's hard for young people today perhaps to believe this, but home loan rates got up to the high teens percentage. You pay a variable home loan rate of 17 or 18%. It's almost unbelievable that such a thing could ever have occurred. That in turn generated an extremely severe recession in the early 1990s, the last time Australia had a very severe recession. But even without doing that, so for example, in the early 2000s, Australia had an incipient housing market bubble that was eventually choked off by some action by the Reserve Bank when, towards the end of 2003, because they were aware that it's a dangerous thing to let housing prices get too much of a sort of internal momentum of their own, where prices rise purely because prices have risen in the past and everybody thinks they can get in, flip houses over and so forth. That's the sort of nature of a bubble phenomenon, and that's what you want to stop occurring. What makes the current situation so difficult, though, is that the Reserve Bank, since the end of Glenn Stevens' tenure, has washed its hands of the housing market. You have had this bizarre situation where house prices were able to go up. In Sydney, house prices went up 75% over a 5-year period from mid-2012 to mid-2017. And yet the Reserve Bank was still spending all its time fussing about whether inflation was at consumer price inflation, that is the inflation of a basket of goods involving bread and meat and milk and juice and so forth, and other electricity, gas, etc. They were saying, well, we have a target of 2 to 3% on average over the cycle. Oh, inflation's a bit below that target, it's 1.6%. We better not raise interest rates. And it struck me as increasingly bizarre that you would ignore these developments in the housing market and fuss about whether inflation is a few tenths of a percentage point outside your target band. Now, again, I should be clear, there were other factors at play which made it very difficult for Glenn Stevens, who was the governor of the Reserve Bank before the current governor, Phil Lowe, made it very difficult for him to respond in 2012, 2013, 2014, 2015. The main problem there was that Australia's exchange rate, the Australian dollar, was extremely high. It got to a situation where it was approaching $1.10 American, which is, again, it's unprecedented for the period since the Australian dollar was floated in the early 1980s. So there were reasons that made it very difficult for the Reserve Bank to react as it might have liked to do. But nevertheless, Glenn Stevens, for example, did a good job. He held interest rates, the cash rate, in the face of this price rise, as high as he could when he was having to balance all these other competing considerations. The weird thing is that since the end of his tenure, we've had a situation where the Reserve Bank has just continued to cut interest rates. It's continued to do so, especially in the period since the housing market, after a brief correction, stabilized in mid-2019. It's just continued to cut interest rates even before the pandemic arrived, notwithstanding that massive house price appreciation that had occurred. And that's what makes it so difficult to know, because in a sense, housing bubbles can go a long time. It's very hard to know when they will just pop of their own accord. They do eventually sometimes roll over, as occurred in 2017. Eventually, the Reserve Bank didn't raise interest rates, but the imbalance has just become so large that there was some correction. But since then, as I say, we've moved to a situation where the Reserve Bank's running zero interest rates and promising to do so for an extended period into the future and running quantitative easing. When the Reserve Bank's doing that, they can keep a bubble propped up for a long time. They can't do so indefinitely, but they can keep it propped up for a long time. And that's what makes it so hard to say exactly when a correction might occur. But just to give some perspective here, we just saw data from the ABS recently, the most recent data for the September quarter last year, which said that house prices in Sydney, the mean house price, average house price, went up $65,000 in 3 months and is now over $1.1 million. Now, I don't believe that's a sustain when total average full-time earnings are typically about $90,000 at the moment. That's not a long-term sustainable level, especially when growth has been so anemic. Wages growth has been well below the level of consumer price inflation for a couple of years. It's not a long-term sustainable situation. So there has to be some correction, but the Reserve Bank is making it very hard to know when that correction would come, rather than trying to shepherd through a correction in an orderly fashion, which is what I believe they should be doing.
There's been quite a few suggestions thrown around of how to kind of lower the housing prices. And one of the suggestions that's been thrown around is touching on the fact that some people feel that immigration is too high, and that if immigration was, for example, halved, that perhaps then housing demand wouldn't be as high. In your opinion, how much of an impact does immigration rates have on housing prices in Australia?
I think they have, and indeed I argue in my book actually that they had a significant effect on housing prices between about the mid-2000s and really the period to the most recent pandemic. We have a situation now where one of the, if you want to talk about one of the benefits, uncovenanted benefits of a pandemic, it's a dreadful thing, and the horrific violations of our basic freedoms and our basic capacity to transact in an economy and so forth have mean that it's been an awful period for policy the last 2 years, but at least it has had the silver lining that actually there's been a reversal of migration, and that's taken some pressure off housing prices, because believe me, it would have been even worse than, we've still had astronomically increasing housing prices because of the behavior of the Reserve Bank, but if we'd still had immigration running at the levels we had prior to the pandemic, rather than an actual net outflow of migrants, as we've had in an unprecedented way in the last 2 years, it would have been worse. So again, just to give you some perspective here, we had a situation for the 25 years through until about mid-2000s, about 2005. So under the Hawke-Keating Labor government, then under the first 10 years of the Howard government, we averaged net overseas migration intake of about 100 or 110,000 a year. Now, that was actually extremely rapid by the standards, on a per capita basis, by the standards of developed economies. So it was actually already the most rapid in the whole of the OECD, with the exception of, there were two exceptions. One was Israel, when it had a massive influx of Russian Jews escaping the Soviet Union after the collapse of the Soviet Union. And the other was Luxembourg, which is a tiny European tax haven, which at the time had a population of less than 500,000. And so it just had an influx of people trying to get away from high European tax rates. So leave aside those two trivial and unrepresentative counterexamples, Australia already had as the highest, basically the highest per capita immigration rate of any developed nation. And yet in the mid-2000s, from about 2005-6 onwards, we suddenly doubled that. Now, again, when we were leading up into the peak of the mining boom and the unemployment rate was getting down in a genuine way to, very briefly, for 1 month, it had a 3 in front of it, the unemployment rate, actually in early 2008. You could see an argument for temporarily allowing increased immigration because, as it were, the economy was bursting at the seams in terms of demand for jobs. Demand from businesses for people who could do jobs. But that hasn't been the case since the global financial crisis brought that to an end. That hasn't been the case, and yet we continued bringing in immigrants at double the rate. About net overseas migration on average about 230,000 in the period post then until the recent virus. And if you do a back of the envelope, you can do a very simple back of the envelope calculation. It just says the number of people on average per Australian household is about 2.5. So if you just look at the incremental increase in the migration intake and work out how many houses that requires to house Australians, and then you look at what that is as a share of the number of houses that were typically being built, you incrementally added about an increase, just the increase from immigration was worth about 30% of all houses that were being built. And you can't make such a huge increase in demand without having a big impact on prices, because the housing market is notoriously a market where it's very difficult to get supply to respond. State governments, especially in New South Wales and Victoria, had some success for a few years in improving housing supply, but it's not, if you increase demand by that much and you do it year after year after year, you have a big impact on house prices. And that's why I say, actually, you can trace it through in detail in data at both a national and a state level, and I actually do so in my book. You can see how we went through this period where we'd had this long transition in housing prices to a new sort of level as a result of the move to low inflation and financial deregulation. We then had a brief few years where they sort of stabilized, but instead of locking that in, we built up this massive extra demand from immigration and drove the huge price appreciation that occurred, especially in Melbourne and even more so in Sydney between 2012 and 2017. And then we've never really recovered from that. We had some correction through to 2019, but unfortunately the behaviour of the Reserve Banks unwound that again. So my desperate hope, though I don't expect to be disappointed on this, unfortunately, my desperate hope is that as the virus recedes, and as we come to our senses about the massive overreaction we've made in policy terms, one thing we will not do, I hope, is go back to a situation where we go back to net overseas migration figures of 200, 250,000 a year. We could still have a very strong migration program of the order of 100,000 a year as we used to, and that would be a positive thing for Australia, but it would relieve the pressure on the housing market and it would also relieve the pressure on wages, because real wages have really struggled over the last decade and especially over the last couple of years. And it's very damaging to ordinary Australian workers, and it's very damaging in particular to young people to have this situation where businesses effectively are being allowed to sort of outsource their labour and use the importation of foreign labour as a way of undercutting the bargaining power of Australian workers.
So if everything you're saying is true, if you're saying if the immigration rates were even just reduced by half, it would relieve pressure on housing prices as well as wages, why do you think current governments are kind of, so addicted to keeping the exact same rate or increasing immigration rate?
Yeah. Well, I fear, the answer I would give, and it's depressing to say it, is that they are, as it were, both Labor and Liberal are in the pockets of different groups, as it were, who have greater influence than the mass of the Australian people, because the mass of the Australian people they like a strong immigration program, but they like one that's much more like what we had under the Hawke Keating government and the Howard government for the first 10 years of that government. The problem is, well, it's twofold. First of all, one way, Australia went through a 28-year period after the early 90s recession where we didn't have another recession. And one of the unfortunate impacts of that on policymaking was that every government became desperate. It was not going to be the government that would allow a couple of quarters of negative growth and break that cycle. So one way they did use to prop up growth was simply to just jam more and more people into the productive process. So we had this situation in the post-Howard government period under successive governments where unfortunately overall growth, total GDP growth on average was considerably weaker than it had been under the Howard government. And yet even that weak growth was only being propped up by having a high immigration intake. Growth per capita, growth per Australian was actually very weak. So that was part of the reason that even so, governments were nervous about cutting immigration because they worried it might make it easier for there to be a quarter of negative growth. Happily, again, that's one unfortunate, it's unfortunate you never wish that we have a couple of quarters of negative growth as we did at the start of the pandemic, but at least one happy outcome of that is that we've now broken that 28-year cycle. So governments ought to be able to be more rational about this going forward. But unfortunately, I think the political calculus at the moment is that the Labor Party thinks high immigration is good for it in the long term because it thinks new immigrants tend on average to vote more for the Labor Party than the Liberals. That's perhaps less true than it used to be, but I think that was the calculus for the Labor Party initially. And the Liberal Party, unfortunately, I think, is increasingly in its representative part of the Liberal Party, not the rank and file, but the representatives of the Liberal Party, parliamentary representatives, are increasingly focused on what they think the interests of big business are, not the interests of average Australians or in particular small business. The Liberal Party used to be very much focused on being the party of small and medium-sized business and entrepreneurs and people wanting to get ahead in life. Unfortunately, there is an increasingly strong component in the representative part of the Liberal Party, which is very much focused on what big business wants. And what we've discovered is that big business has been pushing ever since, as I say, they got the foot in the door as we were heading towards the peak of the mining boom at the end of the Howard government. So I don't really blame the Howard government for allowing a big increase in migration at that time, but it should have been a very temporary thing. Unfortunately, what happened was they introduced the 457 visa process and various other visas, which were then never wound back and became enormously rorted by big business. And big business loves the idea that they don't have to pay nearly as much for training costs because they can bring in workers from overseas. What's more, even just the threat of being able to bring in workers from overseas allows you to undercut the bargaining power of your workers, which is one of the reasons why wage growth has been so comparatively anemic, much weaker in the decade since this in 2010, say, than it was under the Howard government, where real wage growth was very strong. So I think it would be great if the Liberal Party would get back to its roots and realise that it ought to be focused on the needs of ordinary everyday Australians and in particular small and medium-sized businesses, not the interests of the big end of town. But unfortunately, they've got a very strong grip on the political process at the moment. And that's why I think the Liberal Party, that's why I'm not optimistic that the Liberal Party will do the sensible thing. That said, I'll just finish with one quick comment. To give credit where it's due, Peter Dutton, when he was Immigration Minister, responsible for Home Affairs and Immigration, did actually manage to engineer more or less on his own and more or less by doing this secretively, as it were, almost behind, without being able to be sabotaged by then Prime Minister Malcolm Turnbull, did engineer a reduction in our net overseas migration target, or a permanent migration target, of about 30,000 back in 2018-19. It got sort of formalised. So that was a good start, but it was a very small start. And I fear the pressures are all going the other way towards increasing the migration intake again as soon as the pandemic allows.
Dominic Perrottet once said that he was going to implement a land tax and abolish stamp duty. How do both affect house prices?
Oh, well, yeah, it's a very good question to be focused on this, because this idea of a land tax for stamp duty swap has been a perennial focus of the commentariat, the economic class, for, well, my entire time working as an economist, and going back even before that, I think. And in terms of how they affect house prices, well, in principle, you expect taxes, any form of tax, will increase the price that's paid for something. However, in the case of housing, the housing market, there are actually good reasons to believe that the current system we have of stamp duty, or even if it were replaced then by a land tax, might not make that much difference to the prices that we pay overall for our housing, because it depends how, to go into a bit of economic jargon, it depends how elastic the supply of housing is. If you have a situation where people are prepared to pay $1 million for a house, at the moment, say in Sydney, that would be below the average, as I said, at the moment, but if they're prepared to pay $1 million, then the moment they might factor in that to pay for that house, they might have to pay $40,000 or $50,000 of stamp duty. Now that's that's an enormous sort of deadweight loss. But the upshot is what they'll do is they'll contract to buy the house for $950,000. In other words, if the marginal buyer will say, oh, I can afford $1 million, then that's what they'll end up paying overall. And if that means that $50,000 goes to the tax man and $950,000 to the seller, that's how the $1 million will be paid. What can happen though is if you get rid of a stamp duty, if there isn't any response on the supply side of the housing market, and it's very, the best guess is it's not completely unresponsive, but it's likely to be largely unresponsive. What will happen is not that the price will drop from $1 million to $950,000. You won't get rid of that $50,000 chunk. All that will happen is the house will end up costing $1 million, and you'll pay $1 million to the seller. So the seller of the house will pick up the extra $50,000, and the buyer won't get anything. Or in practice, there, because it's probably not completely elastic, you'll probably find the seller gets an extra $45,000 and the buyer only saves $5,000. Now, the upshot of that is that when you think about this proposal for a stamp duty land tax swap, it has some merits, and I think on balance, if you could achieve it, it would probably be marginally beneficial. And in particular, it would be beneficial. There's one group of people it would be beneficial for, and at least, again, for young people, maybe it'd be nice to finally have something that's actually a benefit for young people, namely that it would reduce the upfront barrier to getting into the housing market. Because at least if you take again that example I gave, if you imagine that $1 million house, hopefully, I imagine most people getting into the housing market are not thinking of buying $1 million houses to start with, but it's an easy round number. At the moment, if you want to get a loan, you typically have to have a down payment, a deposit of at least, let's say, 20% of the cost. So that would be saying your $950,000 home, you've got to have $190,000 as your deposit to be able to get the loan, to be able to buy the house. Plus, you have to have $50,000 for your stamp duty. So you have to have $240,000 up front. And that's already a really astronomical sum of money for young people to accumulate to be able to get into the housing market. So there's this big hurdle to get in if you're not someone who's already in the market selling a previous house and using the proceeds of that to pay your stamp duty, etc. If you did this stamp duty land tax swap, you would at least ease that burden, because even if the price stayed at $1 million, because you don't have to pay the stamp duty any longer up front, now the 20% threshold for the deposit would be a $200,000. So you've gone from a $240,000 threshold to get into the market to a $200,000 threshold. So you would at least have made it a little easier for first-time buyers to get over that benefit. So that is, over that hurdle. So that is one benefit of the proposal. That said, that's about the main benefit from the point of view of buyers in the market, buyers and sellers in the market. The main benefit of this proposal is actually really from a government point of view, and this is one of the reasons it gets pushed so strongly. A stamp duty land tax swap, the thing is, stamp duty is an extremely volatile source of revenue. It's volatile not merely because if prices go up or down, the amount of stamp duty paid changes a lot, but also when you go through booms and busts in the housing market, the volume of transactions, the numbers that are occurring every month changes a lot. And you can have situations where the amount of revenue goes down by 50%. And at the moment, that matters a lot because stamp duty is actually had become briefly for a while the biggest single source of revenue for state governments, even more than payroll tax. So they'd love the idea of a land tax instead, because the idea with a land tax is you just pay a certain amount, X thousand dollars, $3,000 or $4,000 a year, which is just to cover the costs that the state, well, supposedly cover the costs the state government incurs in administering the land system and so forth. But the point is, you keep paying that whether the market goes up or down, and people pay that whether they're transacting or not transacting. So you would get a much more stable set of revenue, and so governments like that idea. However, the benefits in terms of Joe Blow in the street are much more limited. And in fact, I suppose we can go into this in more detail if you like. But my take on this is, for 20 years in my following this debate, I'd not gone into it in detail myself, but I'd taken it as sort of read that all the people who thought were tax experts and so forth, the Ken Henrys and others of the world, always said this is the single biggest, most important tax reform we could do. And indeed, it is argued if you have a land tax, it's less distortionary than a stamp duty, because a stamp duty, the idea is it can stop people moving because they don't want to pay that deadweight loss of tens of thousands of dollars. Stamp duty, you just have to pay it anyway, so it's not an impediment. So there are some benefits. Nevertheless, when I finally looked into this in more detail over the past, over recent years, the more I looked into it, the more it seemed to me that the alleged benefits of this were less and less compelling. fundamentally, and moreover, the alleged costs of stamp duty. I must admit, I hate the idea of paying stamp duty when I buy a house, as we've had to do. But nevertheless, the actual economic costs of it are nothing like as bad as they're portrayed as being. So my take actually on this whole debate is that it's extremely hard to engineer politically, because you're going to be asking a whole lot of people who don't pay any tax at the moment to pay a few $1,000s every year on land tax. It's very hard to engineer. And the benefits are actually nothing like the scale that they're typically portrayed as being. So I must admit, I'll be really surprised if something like this actually goes ahead, because ultimately, to get it to go ahead, I think you'd have to effectively hand out tens of billions of dollars of sweeteners just to try to buy off all the relevant groups who will be otherwise negatively affected. And then you quickly move to a situation which actually was doing more harm than good. So we'll have to see. And I salute Dominic Perrottet for trying to do a reform there, but yeah, I think it's I don't think it's anything like the magic bullet that people portray it as being.
Yeah. Another solution put forward to reduce housing prices is a reference that Labor makes to removing negative gearing. Now, could you please explain exactly what is negative gearing, how does it work, and who typically is the type of person that uses negative gearing?
Sure. Okay. Well, this is an area where the first important point to make about negative gearing is that in lots of people's minds, it's something that's associated with housing, as though it's a special tax break that's being given for investors in housing. It's something that applies to housing investment. But actually, that's not true. It's something that applies to any investment. So negative gearing applies to investment in shares. It applies to investment in anything else that you might be leasing out or whatever as a sort of business. So what is negative gearing? It's the idea that you can, to give us the specific example of a housing situation where you own a house and you rent it out, the idea is you say, I have certain revenues from renting that house out and I have certain costs associated with that. So the main costs are typically having to pay the mortgage on the house, so the interest costs that you incur, as well as all the costs of the maintenance, maintaining the house in a shipshape condition and so forth, how many $1,000s a year that is. And then the idea is you set that against whatever rent you're getting in from the property. And if that turns out to be a positive amount, the property is positively geared and you have to pay tax on that amount of extra net income you receive. But if it's negative, in other words, if you actually ended up paying more in interest on the property for your mortgage and repairs and so forth than you got in rent, negative gearing just says you are allowed to take that negative amount and set it against your other income. So if you're Joe Blow who has a rental property but goes to work for a company or for the government or whatever and has an income otherwise that's $100,000 a year, and you lose $5,000 in your rental property, you can say, oh, that reduces my income from $100,000 to $95,000, and therefore reduces right off the bat the amount of tax that I have to pay in income tax. The argument of people who say you should scrap negative gearing is this is terribly inequitable and you ought to have to keep that quarantined and set it against any capital gain on the property and so forth. But the truth is, that first of all, when you put it like that, it's actually not a particularly egregious idea at all. Negative gearing is just the idea of saying you should pay tax on your total net income, not on your sort of revenue. So if as an individual, if you think of yourself in that individual case as someone who's working a wage job and also running a small business, which is a rental business, it's just saying you should be allowed to offset the costs that you incur in performing that rental business as part of your taxes. There's nothing particularly offensive or egregious about that. What's more, I think negative gearing has been given this massively unwarrantedly bad press as supposedly a key source of rising house prices. And that's the real reason, for example, that Labor proposed at the 2016 and again at the 2019 elections to scrap negative gearing, other than for the building of new properties. They said if you're buying an existing property, you should not have access to negative gearing. It fundamentally misunderstands cause and effect, though, because as soon as you talk about negative gearing, you realize there's not a single person in Australia. There are lots of people in Australia who are running negatively geared properties, but there's not a single person who wants to be running a negatively geared property if they could be running that property positively geared. What do I mean by saying that? Because after all, why would people do this if they're having to run negatively geared? What it's saying is, on that property, I'm making a loss every year. If it's negatively geared, it's saying I'm paying more in interest and expenses than I'm getting it back in rent. So you ask yourself, why would anybody invest in a investment that's loss-making in terms of the recurrent income? As soon as you phrase the point that way, you realize you should ask the right question. You say, why does anybody do that? It can only be because they expect a massive capital gain down the track, which will more than offset the losses that they're incurring each and every year on the cash flow. So when you posit the question the right way, you realize the cause and effect goes the wrong way around. It's the massive increases in prices that are encouraging people to get into the housing market to make an investment, even though that investment will lose money on an ongoing sort of year on year basis. If you dealt with the problems, the factors, the underlying factors like high immigration and vastly inappropriately low interest rates that are driving house prices to appreciate so much compared to incomes, if you address those factors, the expected capital gain would fall back to a much more normal level. And suddenly people would not think, there would be no particular incentive for people to get into the housing market unless they could earn enough in a rental return on the property. So it's the massive house price inflation that's driving the investor interest, which at the margin is then, there's a feedback effect that at the margin is then further driving up house prices. But the truth is, if you address the underlying factors that are driving up house prices, the whole negative gearing issue will go away. It's not the fundamental driver. And people, I think, believe the Labor Party in this case fundamentally misunderstood the direction of the cause and effect here. Now, I will say one caveat to that. In economics, there's something called the theory of the second best, this idea that there are lots of situations where, in theory, you wouldn't want to do something, but maybe there are so many other distortions in the economy that actually doing that thing might still give you a better outcome than not doing it. And the housing market is, as I've been trying to stress in my answers to the earlier questions, it's a fundamentally important market. Fundamentally important for the whole notion of what it means to be Australian, the whole opportunity for young people to settle down, to be able to start families, to believe in, to go to your first question, Andrew, to believe in the Australian dream, as it were. And that's why it is possible to argue, I think, that although I'm opposed to changes to negative gearing, I think I can see an argument where, because we are being so feckless in our handling of immigration and in our handling of monetary policy at the moment, you could possibly mount an argument that said, don't remove negative gearing in general for the mum and dad investors, because many of these investors are mum and dad investors looking for a place to park their money, and they've got one rental property. Often there'll be people who had a property, and then rather than sell it as they moved somewhere else, they bought a new one and kept that as a rental property as their way of effectively investing for their retirement. You just don't want to try to hit those people. There's no reason to, and they're not the source of what's going on in the pressure in the housing market. But you could say there are, however, some people who own 100 rental properties, and they've massively geared themselves up. And indeed, unfortunately, I don't know how widespread this is in Australia, perhaps not very widespread yet, but it's become widespread in America. You have situations where you have large, massive financial investment firms, the BlackRocks and the Vanguards and so forth, that have started on the quiet, getting into housing markets and buying up thousands of properties. As partly in that case, as their way of trying to get physical investment to protect, that's their way of trying to protect against some of the risks that come in for high inflation and so forth. Now, we used to get that happening. I actually do subscribe to the idea and theory of the second best sense that implementing tax changes that made it difficult for big financial firms to make large investments in the housing market, or for people, even for individuals to own tens or hundreds of properties, I'm actually on board with that. Now, there'd be better ways to do that, including things like changes to land tax arrangements, so that said, if you own more than 2 properties, or more than 3 properties, or more than 5 properties, you start having to pay a land tax on those properties, even if they're residential ones. There are various other things you could do which would be better than changes to negative gearing. Nevertheless, if you'd made a change to negative gearing that said you're not going to be allowed to use it after the second rental property, as I say, I think theoretically that's a bad way of trying to address the issue, but it would actually still lead to a better outcome than doing nothing at all.
So what are the risks in regard to hyperinflation, and what contributes to it?
That's a good and topical question to bring up. Hyperinflation perhaps puts it too strongly at the moment, but inflation in Australia has, over the period of the pandemic, gone up considerably compared to the levels that it ran at. So this is consumer price inflation, as I say, the price of a typical basket of goods, so the electricity you pay for, the gas, the foodstuffs, etc., childcare and so forth. So we just had a couple of days ago the latest Australian Bureau of Statistics quarterly consumer price inflation data, and that showed a strikingly high quarterly increase. I think it was 1.3%, and inflation on average over the past year running at 3.5%, which is above the Reserve Bank's 2 to 3% target band. Now, again, we've got to be careful not to exaggerate. Just as I was saying earlier, I was frustrated by the Reserve Bank being fussed about whether inflation was a few tenths of a percentage point below the bottom of their target band. They equally shouldn't necessarily fuss about it being a few tenths of a percentage point above the top of their target band, especially given that we've had an extended period where it tended to be a bit below. Nevertheless, we are at a junction where, because of what's happening on the supply side of the economy and a lot of ill-considered government decisions that have disrupted supply chains, and also because of fundamental pressures on the way our whole globalized economy work, or what I hope will produce significant changes in the whole supply chain arrangements of our domestic economy, we are in a position where there's much more inflationary pressure coming through. And although that's true in Australia, you can see it's much more true even in America. For example, at the moment, we have 3.5% consumer price inflation over the last year. In America, it's 7%. And there are specific reasons to do with the way in which that's measured in America, which mean that's a huge understatement. So, for example, that counts about a third of the basket of weights for that increase in America. That 7% rate is based on cost of shelter, cost of housing and so forth. And the figure that's gone into that 7% per annum rate is the idea that housing prices have gone up. The price of getting a roof over your head has gone up by about 4%. But that's because of the long lags in the way that gets measured. If you actually look at what's happened to rents as well as house prices over the past year in America, they've gone up by about 18%, 20%. So there's a lot of additional inflation already baked in that's going to come through as those lags wind off. And so America faces, along with various other effects to do with supply disruptions and insanely stupid government policy by the Biden administration and a raft of state governments there, the Californian state government, etc. They face a really major inflation problem. And the risk is in turn that will actually further generate for Australia inflation problems for us. But already we face a significant inflation problem which is exacerbated by the combination of the boost to the encouragement to people to continue to borrow and spend by extremely low interest rates. At the same time, as I say, as we have still significant supply chain disruptions in the supply side occurring from government policy in relation to the virus pandemic. So we're by no means at this stage in hyperinflation sort of terrain, which strictly speaking means the sort of thing we saw in Zimbabwe a decade ago, or in Weimar Germany, where you had inflation of 1 million or billion or trillion %. We're not at that level, but we don't need to get to anything like that level to have really bad economic outcomes. In the 1970s and 1980s, we had inflation average 10, 11, 12%. And that was extremely damaging to the economy, partly because of the way it interacted with the tax system and also because of what it did to interest rates. And again, we have a situation where even 3.5% inflation, if we were to be forced to try to get that under control by raising interest rates, we'd be forced to raise our interest rates from effectively zero at the moment back towards 3, 4, 5% levels, which historically would be extremely low. But at the moment, they'd be cataclysmic for households, because at the moment, households, for example, the debt level of households relative to their disposable income, that's risen. That used to be, go back to the mid-1980s, that used to be about 40 or 50%. So the amount you borrowed on average was about 40 or 50% of your annual disposable income. Now it's about 200%. So we don't need to get even to the sort of inflation rates that we had in the 1970s and 1980s before we could get a situation where, if that starts to generate a wage price spiral, the Reserve Bank will be forced to react finally, and that will have really major flow-on effects to the economy. The only way to break that spiral will be to do the sort of thing we did in the early 1990s, which is to create a really deep recession. And again, because many of you probably don't remember the early 1990s, unlike me, that was a period where the unemployment rate got over 11%. Now, we all fussed after the global financial crisis because for a couple of months, the unemployment rate got over 6%, briefly got to like 6.1%. 11% unemployment and youth unemployment rates, 35, 40%. That's what we saw in the early 1990s, and it went on for years. And that's the sort of dangerous terrain you get into if you start to let inflation get out of control. So you're absolutely right to be saying we ought to be worried about this and very vigilant not to let it get entrenched.
You touched on a few different countries there when you were referring to inflation. Coming back to the housing prices, is this an Australia only issue, or is this something that's happening to lots of different countries and cities around the world right now with high property prices?
Yeah, it's not an Australia only phenomenon. I'd have to say I haven't actually looked in detail at the data for a range of other countries for a little while now. But the interesting point is that it does vary from country to country which assets the inflation shows up in. So we have had in my view, grossly reckless behaviour by monetary authorities by a raft of countries around the world. In fact, as I say, under Ian Macfarlane and Glenn Stevens, Australia did very well in not joining that stampede towards extremely low interest rates. And it was only recently that we've joined that cabal. Unfortunately, we seem to be very happy about having done that, and we ought to be very ashamed and doing our best to get out of that. Nevertheless, the point is interest rates effectively have been around zero for almost the whole time in the United States since the global financial crisis. So they stayed at zero, actually at zero, for a good 8 years after that, 7 years, almost 8 years after that crisis occurred. We then raised very gradually for a period, a couple of years, and then they only when their equivalent of the cash rate was in the twos, they got cold feet and started cutting it again, and then went back to zero with the pandemic. In America's case, that has showed up most recently in terms of serious growth in housing prices and distortions in the housing market, and that's interacting also with problems in the construction side of the housing market as well. But actually in America, it showed up more strongly even in the stock market. So whereas Australia's stock market after the financial crisis, we didn't pass the level we were at immediately pre the financial crisis. So go back to mid-2008, we didn't get back to that sort of level until a full decade later. And even then we barely sort of got above there, and we inched a bit above, then lost momentum, etc. Whereas you look at America, they had a big fall in stock prices after that, but then the stock market, the Dow Jones and the S&P 500 and so forth, all came rocketing back and went past the previous level and kept driving on and on and on upwards. Now we're seeing some corrections apparently going on, and it's not a second before time to get some corrections to those absurd levels. But there's an example of how you have a situation where, in part, you have had these problems developing with house prices, but it's in America's case, it's shown up more in stock prices. In some other countries, it's shown up in a mixture of the two. It varies from country to country which asset class, but the bottom line is, if you make borrowing essentially costless to people, and what's more at the same time effectively therefore mean that they can't get any return on any savings they have by doing sort of low risk things like investing in bonds and so forth, putting your money in the bank, you'll encourage people to go out and bid for assets, and that will drive up the prices of those assets. Unfortunately, that has also really bad effects, because it effectively amounts to a massive wealth transfer from people who have access to the capacity to borrow, which is typically people who already have assets, and away from people, especially young people, who don't have the assets to do that. They're the ones, in a real sense, their real wealth goes down, and the real wealth of the people whose prices are being bid up goes up, at least until such times you get a big crash and some correction to that.
We've seen that Australia's unemployment rate is at its lowest even compared to prior to COVID. We've been hearing about the phenomenon called the Great Resignation, where people are quitting their jobs in large numbers. Sometimes they're citing exhaustion or poor working conditions. Will this threaten our economic recovery?
I think it has the potential to, though I think it also has the potential to do some good things, the sorts of things that policymakers too rarely talk about, which I'll come back to in a second. Let me just begin by saying that it's a very good question for us to be focusing on, because first of all, I think one of the impacts of the pandemic, and I don't blame the people at the Bureau of Statistics and so forth who are doing the measurement, but we're told we have an unemployment rate of 4.2% at the moment, and yet the total number of employed Australians has only just in the last couple of months basically got back above where it was 2 years before, and it's barely above that. So that would normally, you would have expected us to have added close on 500,000 jobs by this stage. So we're actually at a situation, this goes to this point about people dropping out of the labour market, just not wishing to work or cutting back their hours, that there are, I think the 4.2% unemployment rate massively flatters the state of the economy. So again, we're in a situation where measured GDP is actually below where it was pre-pandemic. So if you look at the unemployment rate and you think, wow, we haven't had a 4.2, there's only been a brief period pre the mining boom in 2007-8 where we ever got to that level. This looks like we have the hottest economy we've had in 30 years or something, but it's just giving you a misleading impression. And it's much more helpful these days to look at things like the employment to population ratio or the participation rate, how many people are actually in the market. And there you see a whole lot of people have dropped out or cut back. Again, it's very hard to measure because there are so many people who have been restricted on the supply side. They're told your business can't open or it has to work in a very restricted way. And this may not affect people as appropriately referred to somewhat disparagingly as the laptop class, the people who are able to work from home and carry on as normal. But there are a lot of jobs out there where people have been immensely disrupted, and where small businesses also have been immensely disrupted. And I think there are a range of things going on, and I can only talk about this anecdotally, but my sense is there is something of this great reset going on. I think it's, again, much more pronounced in America than it has yet become in Australia, but I think it may become so. Part of that is there are a lot of people who are just fed up. They're fed up. They think this whole rat race that they got into, it was possible much more easily to believe that you were heading somewhere good and that this was a worthwhile investment of your time. And now for many small businesses, you see, you spent a decade or 2 decades setting up this business, and then the just on a whim edicts of government health bureaucrats and gutless politicians who hide behind them just took it all away from you. And they said, oh, we'll pay you some money to try to keep open or whatever. But for many people, that was an inadequate compensation. And in any case, they then are allowed to open up, then they're shut down again, then they're only allowed to do this with restrictions. There are all umpteen laws they have to fill in. They have to fill in all these forms and have government bureaucrats crawling all over their paperwork to determine if they're allowed to operate this basic business. There are a whole lot of people who will just give up, as it were, I think, or unless we do something dramatic to try to change the equation for them, who'll just say, there's no point trying to start a small business in Australia anymore. Why would I want to do that when I'm at the mercy of all this interference and regulation and gross, in my view, gross misweighting of the costs versus the benefits, because that's the key point here. If we were dealing with the Black Plague or even with the Spanish flu, some of what the governments have done might have been justified, though even then they shouldn't have been continuing 2 years later on an emergency basis rather than being done through good order in democratic processes. But we were not dealing with that. We are not dealing with that now. We ought to have been focused on targeted measures at at-risk populations, and that would have meant that actually a whole lot of the restrictions we put in place would not have been made, and I think we would have been fine to do that. And a whole lot of people's livelihoods would not have been torn away from them or destroyed in that process. On top of that whole business, a whole lot of people thinking, why am I bothering? It's really tough to be in the private sector and try to make it cross these days. You also have the point that a whole lot of people have weighed up how tough it was, how they don't seem to be getting much of a return, how actually this big business seems to be doing really well while they don't get much of a return. And many people may be also trying to reorganize their social lives as well. And so I think there may also be, I'd like to hope there might also be a modest element here of people saying the whole model of husband and wife getting together, working their guts out to try to get enough to buy a house, etc., in, say, central Sydney, and to try to get ahead. Maybe that's just the wrong approach to life. Maybe we ought to say, I'm actually going to go out to regional, Australia, try to find a house that costs a whole lot less, have one of us cut back, maybe whichever one, only work part-time, or maybe we can spend more time looking after the kids and having more of an actual family life. And actually, oddly enough, that will do bad things to measured GDP, but in the long run would be a really good development for Australia, in my view, not least because, again, we're sort of running out of time to discuss this, but there are really ominous demographic developments going on in Australia just in the last few years, really big shifts that no one is talking about, and that are really the things that policymakers ought to be focusing their time on and are not. And actually having the sort of shift I was just describing would be one of the ways of trying to address that, actually, and it would be an altogether good thing. So maybe some of this great reset might actually be, again, a sort of long-term benefit, even though it would seem to be a short-term cost.
And I am aware of the time looking there. We only have about 2 minutes left, but our final question does actually relate to what you were touching on between the rural areas and the more urban areas. Towards the end of last year, the head of the Australian Greens, Adam Bent, he promised if he wins the election, he would build 1 million affordable homes in Australia's major cities. Now, at the time, a lot of people kind of felt it was quite outrageous. Some even felt it was laughable. What would be the impacts of doing that?
Well, it's not, I'd love to know what time frame he intended. Just to put that in context, there was a period in the middle of the last decade where we started to manage as a nation to be able to produce more houses for a brief period. That's fallen back again, around about 200,000 a year. The typical level, which was very difficult to budge for many decades, was that Australia used to complete about 150,000 houses a year. That's across about 145,000 private sector, a few thousand public sector housing. The idea, that we're going to come in and have 1 million houses, affordable houses produced. Where are these affordable houses going to be put? Who exactly is going to be producing them? Who exactly will be allocating them? The entire thing is a pie in the sky bit of nonsense, actually, in my view, and especially the idea that we're putting this in major cities. It's just not a feasible thing. And I'd also say, if it was the Australian Greens doing this, they'd run a million miles from it, because they would want it to be allocated, the access to that to be allocated according to their whims. They want it effectively to become government housing. So, I sympathise with the idea of saying we need, we have a supply-demand imbalance. House prices are absurd, astronomical. But the idea that you can just, by waving a government wand, you will just produce this massive boost to supply, it's just not going to happen. The Rudd government had a go at trying to do this, and it was a fiasco. And that was on a scale that was a tiny fraction of what Mr. Bent is talking about. And what worries me more here, because I am actually, unlike far too many policymakers, I think, I'm really concerned about what's happening with housing prices, and actually think it's really important to do something to make it more accessible to young Australians, housing more accessible to young Australians. But you have to then be realistic about what you can do. And the real problem is proposals like Mr. Bent's just divert us onto pie in the sky nonsense. We'll spend 3 years talking about this and how do we get the land, and having huge fights between state governments and councils and others, and nothing much will happen. And the upshot is 3 years will have gone by and nothing will have been done. Whereas, for example, you could actually do something that would make a significant difference over a decadal sort of horizon, or even over the next few years. There are things you can do right now, like cutting immigration, as we talked about before. That can significantly take pressure out of demand. That's the equivalent. If you cut immigration back to 100,000 a year instead of 250,000 or 230,000, that's the equivalent of building an extra 40,000 houses a year. When you're only building on average 150,000, that's a big difference. That's something you can do. So my main comment here is, I wish politicians, including the Greens, but also especially including the Labor and Liberal parties, would focus on practical things that you can actually do, and do right now. Because the problem is right now, it's not something for us to have pie in the sky things that mainly allow you to talk about how you tried to do something. That's what Mr. Bent's proposal is. And unfortunately, again, that's also what far too many of the proposals from the current Liberal government and the previous Labor government were about. They were about having a soundbite on the TV and not doing anything that will actually address the underlying problem.
And I'm afraid that's all we have time for. This has been a very interesting and fantastic Sunday sessions, though, on the housing crisis. Thank you so much, Andrew Stone, for joining us.
Thank you very much indeed for having me on. It's been an absolute pleasure. Cheers.
No worries. I've been your host, Rory O'Connor, and my co-host, Andrew Cremant. This has been the Macquarie University Sunday Sessions. Thank you so much, and have a good evening.